Netflix stock hasn't been this cheap ever since 2022. Is it the time to buy now, or is there more pain coming? Let's find out. What's up, homie? This is Howie. I'm a principal AI engineer with a PhD in physics. Welcome back to Howieverse, where investing is driven by data. In this video, we're going to deep dive analysis on Netflix stock. First, we're going to talk about the price action. The second thing, we're going to talk about the business fundamental. And the last thing that we're going to talk about is my price target in 2028. Where is it going to trade in 2028 according to my analysis? Let's get to it. First, let's talk about the price action. And I have been eyeing on Netflix stock for quite a while now. Like this is back in a year ago when they announced the WB acquisition and then they canceled it. Like if you can see when they canceled it, the stock just soared to about $100. There's a bit of resistance here. And then it retraced back and then it tried to pierce this downsloping trend line right here, but it failed. But also what you can see is that this, when it fails to break out, it coincides with this 786 line. So this is a very, very important line and there is a lot of resistance there. If it wants to go up meaningfully, Netflix has to pass through that line. And right now we're at the 0.5 line. Back in February, it was touching that point and we are approaching that, right? So you can think of this like $75 line is exactly like a magnet, right? Once you get close to it, it just want to suck you in into touching that line or even pierce to that line unless there's something meaningfully changed in the business fundamental to the upside. Netflix stock would like to go to this $75 line. It's just a magnet where it's once you go into that line, you can see right here, it just want to go there. Okay, so that is the first thing that is going to get to that line. Once it gets into that line, what's next, right? So the next thing is that either it is going to pierce all the way through and go to this $61 level, or it's gonna bounce. Most likely it's gonna bounce, right? So the reason why I say this, like in the beginning of the video, if you pay attention, I said that Netflix hasn't been this cheap ever since 2022. Now in 2022, where's the price at? The price is at about $16, right? How am I going to differentiate when the price right now is $77 and at $16? Let's look at the statistics, right? So if you go to the financial and if you go to the statistics, the price to earning ratio right now is 24-25, right? So that's the PE ratio. That's one of the statistic that you can use to judge how cheap a stock is based on the earnings, right? So basically in 2022, it was at 29x. So 29x in 2022 right now is even cheaper, or it's even cheaper than when it was in 2022. But is this justified though? So I'm going to look more into the fundamental. We're going to explore that, whereas I'm gonna show you why this 25x is not actually 24x. It's actually closer to 30x. Now, because this is actually closer to 30x rather than 25x, if it wants to go down from 30x to 24x, there is another 25% drop. If another 25% drop currently is trading at $77, that means Netflix stock is actually at $57. Okay, so that is quite painful in terms of the PE compression. It ever happened to go down to the 24x level from the actual PE that we're going to see next in the business fundamental. Let's explore why I say the PE is actually closer to 30x. This is the quarterly earning of Netflix on the previous quarter, and we're going to explore in depth what the number means and what it means on the business fundamental of Netflix. And the first thing that we see here is the income statement, where the revenue is going up 16% from the same quarter last year. This is in 2025, which is really solid growth in terms of the revenue, and the sales and marketing is only going up by 12%. I would like to see all of this cost, like the cost of revenue, sales, marketing, technology and development, and administrative stuff, has lower growth than the revenue, which means is that if it has lower growth than the revenue and the revenue is keep increasing and keep growing, is that they have scalability, right? So obviously Netflix has scalability despite of the 43% increase in G&A, and also the blow up in the sales and marketing at 22%. They're still able to improve their operating margin, right, at 18%. So in the previous month, it's going up by 56 basis point, which is overall really, really good. So they're spending money on more marketing, on more G&A stuff. That's all good. I do not have problem with that, right? So sales and marketing is a really important part of the business. Now, what they have here is this WB termination fee at $2.8 billion, right? And the reason why they have this is that the deal fall through and they just got this termination fee from WB as a part of like, hey, we're not going to go with you, but here's some chunk of money. It's pretty significant at 2.8 B, which we're going to look at the free cash flow later. This is like about the free cash flow that they generate in 3 months. Now, the thing that I don't like is that so the $2.8 billion, it actually elevate this net income, right? It makes it seems like Netflix is making more money than it used to, right? The thing is that if you don't pay attention to this, this is only a one-time fee. This is not a recurring fee that WB is going to pay this every single month to Netflix. So this is not actually the business itself. This is just one-time event. If I strip out that one-time event, right, the net income only go up by 2.8%, which is very low. If you look at the revenue, it went up by 16%. The net income only went up 2.8%. This is because the tax increased from 10% to 19%. Then as an investor, if you have tax, you need to bake that into your calculation. If not, then this thing is just going to look too elevated, right? And they also need to pay tax on this termination fee as well. So essentially, I give this B plus income because the SG&A blow up, and also there is this one-time income that is from the WB termination. Overall, if I just strip that out, I only get 2.8% net income growth. So it's it's very not encouraging when you see that the top line is growing this much, but not the bottom line. Now we're on the cash flow statement, and if you look at the amortization of content asset, that was the first thing that grabs my attention, is that they have been producing more content. They spend more money on improving their business, making more content for the audience, which is really good. However, things that is less obvious is that if you look at the operating activity at $5.2 billion, strip away the PPE at about 200 mil, that gives you about $5 billion in cash flow, okay? And you have to strip away the $2.8 billion of that one-time payment. So the free cash flow is actually close to $2.2 billion, which is not very encouraging, right? And with that, if I strip away this $400 million from this amortization of content asset, That gives me like about $2.6 billion. So essentially, the free cash flow growth, if you think about it, it's flat to slightly negative. So it's not that this negative 21%, but it's still flat to slightly negative. As a business, I would like to see the free cash flow grow even more. So overall, I give this cash flow statement B minus because when you strip away everything that is one-time payment, you get a negative cash flow. Nothing concerning for this quarter. If this keeps going on, then it's going to be a concern. Now let's look at the balance sheet. The first thing that grabbed my attention is the 15B in cash, which is plenty enough to pay their current liability at 12B. So they have an excellent balance sheet right now. The one thing that I see here that I don't like is the $13 billion in long-term debt. That's about 1.5x of the free cash flow. I would like to see that going down to less than 1x of free cash flow. With that being said, I'm going to give the balance sheet an A minus because of the long-term debt. If they can get that down to less than 1, that will be an A. And I would like to speak a little bit about this long-term debt, okay? So the reason why it's really important is that in the beginning of the video, when you see the price action, when they say they are going to acquire WB, the stock plunge. And when they say they are not going to go through the WB acquisition, the stock actually soar. So the reason why is that Netflix do not have enough money to buy the company. So when they don't have enough money, what are they going to do? They are going to issue more debt. And if they issue more debt, that means the balance sheet is going to be off. The balance sheet is going to blow up. That is why investors are punishing Netflix on trying to get through that acquisition where they do not have enough money. And essentially, this is why we do this, right? This is why we look at the balance sheet. That's the company has enough money to acquire stuff, has to buy stuff, right? So this is very important. If you don't look at this, the investor is going to punish the stock price, and all of a sudden you're like, oh, why is the stock price going down? And this is exactly the reason why. Stripping away the $2.8 billion, which is the one-time income, and it's not a recurring income to make the net income looks more elevated, the actual PE of Netflix is closer to 30x, not 24 or 25x as we saw earlier. Why this is important? Because it's trading at $77. If it's ever go to the true PE of 24, there's another 25% of price compression, which going to take the stock down from $77 to $57. That is a lot of pain. And my EPS growth projection is about 15%, which is very conservative. And that gives me the pack of 2, which is not exactly cheap. Here, look at this again. So the PE in 2016 is 287, 153, 99, 78, 88. So all those years, Netflix has been trading at premium price to earning ratio, right? And if we look at the chart right now, right? So where is it currently trading at around $77? And if it ever compressed to around $57, it's very close to this line, which what we talked about earlier, if this ever break down of this line right here at 0.5, it is going to stop here next at around $57. Now, in terms of my price target of 2028, I give it $4.68. And this is very conservative, just basically saying that if Netflix stock performing like they are right now, they are going to get this $4.68 in EPS. That means my price target on the bear case, this is essentially at 15 PE, saying that if there's recession happen, My bear case is at $71, which is very close to what's currently trading right now. And I believe Netflix is a consumer defensible. That is because that people are still needing entertainment. If recession ever happen, they would likely to not going to movie theater and just going to have their entertainment at home with Netflix. Do not have to purchase $10 popcorn. They can make it at home. So that's why I say that Netflix is one of the recession proof stock out there. Because of this reason, people still need entertainment and they provide cheap and plentiful entertainment. My base case is at $141. That is assuming that everything is the same, essentially about 2x from here. And the bull case is that when you get this growth acceleration, which I see when Netflix will be able to take their advertising business going in the acceleration mode. So my expected price target, assuming weighted, is at around 154 or about 2x from here. So Netflix stock is not particularly cheap right now when we strip away that one-time non-recurring income. As a matter of fact, it has never been this cheap ever before. It's always been trading at premium because it's recession proof, right? As we talk about, this is consumer defensible. People still need entertainment, and Netflix can give you a lot of content for cheap instead of going to theater spending $10 on popcorn and stuff like that. If you like video analysis like this, please hit the like button down below. And if you like more analysis like this, consider subscribing. I'll see you in the next one.